The Rebel Capitalist Show.
I want to go back to the TGA just a moment, try to sort through kind of some like a thought experiment. And I was trying to think, okay, you've got the yield curve. If the short end goes negative and the long end of the curve, you get this steepener effect that you were talking about on Macro Voices. I'm assuming that there's a lot of hedge funds, sovereign wealth funds, financial institutions that would run into a world of hurt if the T-bills were trading negative. Or I should say I assume the Fed would not want T-bills.
But I don't think though the Fed doesn't want that for a world of hurt from the hedge funds. I think that the Fed doesn't want that because it messes up money markets. Because they can't, there's all sorts of like plumbing issues with just the day-to-day things that they don't want negative T-bills. And I know we've had negative T-bills for short periods, but to have them on a sustained basis would not be good. And I don't think any of our systems are really designed for it.
Okay.
Like, and I think it has more to do with that. Like, just even think about money market funds. Like, don't you buy it at $1 and just earn interest? Well, what happens now all of a sudden? How do you buy it? And, how do they charge you? Like you buy it at $1 and then you have to give them another,
Yeah. What does the average Joe do with that? Exactly.
So I think that I actually think that side of it is not really a market concern so much as it's a plumbing concern in terms of some kind of short end things. And I actually, I'm not that concerned about that side of it. If anything, if the Fed was thinking about it kind of thoughtfully, I think they would be more concerned about the dollar or something, or like another, or even a melt up in the stock market. Like at the end of the day, I don't think that I don't think they're prepared to go raise rates or talk.
Okay, so that was basically my question. Do you think that they get to a point where they're like, okay, we can't have these negative rates on the short end, therefore, even though we don't want to, we've got to raise the Fed funds rate up to 50 basis points, 1% or whatever, to try to bring up that low end of the curve?
So no, I don't think that they would do Fed funds, but I think that they're going to go do a technical adjustment on the IOER, the interest on excess reserves. And that's something I wrote about. I said that chances are they're going to increase that while leaving their Fed funds target unchanged. So you might see that go up by 5 or 10 basis points, just enough to pull, to help in terms of bringing it up. And one of my concerns was that if you weren't aware of that and you weren't thinking about it and you just saw on the next, March FOMC meeting, you saw Fed raised rates, you might go, holy smokes, I'm going to sell everything, sell my stocks. And you might view it as the Fed being hawkish. Whereas in reality, the reason they're raising the IOER is because there's so much liquidity. So it'd be they would be forced to almost do this raise just to keep the base, keep it from slipping below zero. And even though you might think, oh, that's bad, they're taking liquidity out of the system, the reality is that the reason they're taking out liquidity out of the system is because there's been so much added in another way.
Right. So what do you think that does to the long end, if anything?
So I don't think
they raise IOER.
I don't think it does anything. I think the long end is going to trade on inflation expectations. And I think that the long end will start to, I think the long end is looking at it and trying to decide if the Fed is serious about leaving rates unchanged for as long as they are. Mm-hmm. So if you think about a long bond investor, what is their worst nightmare? Like, let's take default off the table, right? Like, because let's face it, U.S. isn't going to default on their debt. So let's take that off the table. The long bond investor's worst nightmare is inflation.
Right.
So even though everyone thinks that the Fed raising rates, that must cause bonds to go down, the reality is, like, if the Fed turned around tomorrow and raised rates to 100 basis points, maybe the long bond would go down for a little bit, but before you know it, the long bond would be screaming because what would happen is the economy would implode, and therefore you would find that people would be like, I got to own a safe asset. I want to own the longest duration asset. I'm going to buy bonds. So if we think about what the Fed's been telling you over for the last 9 months, ever since COVID, they've been telling you we want to let the economy run hot. We're willing to allow inflation to run hotter than it previously has.
Right.
We want the 2%, whereas when we used to get upset about 2%, we're going to let it run 3, 4 before we get upset. So if you're thinking about it from a long bond investor's kind of, perspective, what that means is that you're going to get your asset inflated away. So you don't want to own, like in that environment, you don't want to own long bonds.
Right.
So when you go back and you ask, how is the TGA going to affect it? I think that all of these things are telling the market that the Fed and the government are doing more and more to create inflation. And therefore it behooves you to be less long, long bonds, like long duration bonds.
At what point do you think they have to peg the long end?
So a lot of people, if you remember back, like, the 10-year went to 50 basis points in the COVID crisis. And then on the way back up, I would turn on the Twitter or turn on, read my research, and all these people talking about, we have to peg it at 1, we have to peg it at 110, we have to peg it at 120. And I'm just hearing all these guys, and I kind of think to myself, it's all the bond bulls that want you to peg it. Like they're the ones. I don't view a steep yield curve as something the Fed is against. I think that it's actually, as long as it's steepening because of future inflation or future growth, I think it's fine. And I think the government will be fine with it. One of the things that I do think
is different than growth, right?
Well, I think
you can have higher prices, but it
I
doesn't
don't think
necessarily mean the
they
economy
really care, to be truthful. They need nominal growth. And whether that's 2% real and 3% inflation, or 4% inflation and 1% real, I don't think they care that much. Like, I think what they don't want is like there to be a problem. Like bonds went down in during the COVID crisis because of actual problems in the market. Like that was a different time. Like you actually saw there wasn't enough money in the system and bonds were actually not bid. Right. And that was like an actual market dislocation. And it wasn't that they thought that the Fed was, that we were going to have inflation, that like the system stopped working. Right. But if you have a situation where the long bond is going down in yield, and as long as it doesn't do it too quickly, I think that they're going to be fine with it. And if you think about it, if they want health in the system, there's nothing better than having, like a steeper yield curve. It helps banks. It helps a lot of parts of the economy. And I look at it and I say, I don't think the Fed's going to do it. Like, I just don't buy it. And everyone says, well, they can't afford to have it go up. And I go, well, they're just going to float more at the short end. And we're just going to do it. And like, it might not be the right decision, but again, stop worrying about the right decisions. Just start thinking about what they're going to do. When you listen to them, they're telling you they're not going to do it.
Like, I just wonder about like mortgage rates. If you get the 10-year going up to say 3%, 4%, something like that, then you think through mortgage rates and then the housing market and how dependent the economy is on home equity. That's kind of what I think.
Yeah, I guess it'll depend on how the economy is doing. Right. And maybe they'll figure out ways to boost, like to tighten spreads against mortgages. Like maybe they'll go and, boost that.
Mortgage-backed securities.
Yeah, or like, you change the tax. There's a million ways to do things. I just don't know why we're in such a rush to peg the yield curve. Like I always tell people, I go, pull up a 40-year chart of 30 years, or 10-year bonds, and then tell me why you think that this move from 50 to 1.25 or wherever we are is now all of a sudden we have to peg the yield curve. Like, you realize that in like in 2018, which was just 2 years ago, the long bond was 3.25. The economy, wasn't great, but it wasn't the end of the world. Like, we were still managing. And so to me, I don't buy this peg the yield curve. I think anybody that is talking about pegging the yield curve is too focused on monetary means of stimulating the economy. And so if I'm correct that it's going to be more the government spending money into existence, we get more, actual government infrastructure spending and stuff like that, the long end will move around and it won't matter as much as everyone thinks it matters. People are just thinking to themselves, they're fixated on this idea. The only way to get the economy going is through private sector credit creation, and they're ignoring the possibility that the government could actually do it. And now you might hate that. You might think it's terrible. Fine, so be it. But if the government does it, it's still going to mean that the long end could go to 4 or 5%. Like I've said for the longest time that I think before this cycle is through, the yield curve, meaning the difference between the short end and the long end, will go to record wides.
Yeah.
Like I could see a situation where like the short end is 1% and the long end is 6, 7, 8. Like, I could see that happening, before this is all through.